Good morning, good afternoon, and good evening, everyone. Thank you for taking the time to join us today. I am Prasad, Vice President Research at Smith Securities. It's a pleasure to welcome you to our Mid-Year Strategy Outlook presentation. I'll take you through the macroeconomic backdrop and our outlook, and this will be followed by our equity strategy and sector outlook presented by my colleague, Mr. Sachinta Sirivardhana. We will conclude the session with a Q&A. Before we dive into the details, let me first set the context. Sri Lanka entered 2026 on a strong footing following two consecutive years of 5% economic growth. However, the economic landscape changed significantly following the escalation of the geopolitical tensions in the Middle East. This triggered a sharp energy shock. The surge in global oil prices drove up the fuel import costs, putting the pressure on rupee and pushing the inflation to a three-year high. The Colombo Stock Exchange started the year on a positive note, gaining around 5% for the first 2 months to reach around 23,800 levels. However, the index corrected by 11%, thereafter falling to around 21,100 levels as geopolitical tensions and higher oil prices, currency depreciation concerns, and more cautious investor outlook weighed on the market sentiment. Moving on to our economic activity and our GDP outlook, despite the escalation of the geopolitical tensions in late February, economic activity has remained relatively resilient. Both the manufacturing and the services sectors continue to expand apart from the seasonal slowdown in the month of April. GDP growth also remains strong, expanding by 5.1% year-over-year during the first quarter of 2026. This is primarily supported by the industrial sector, which grew by 7.2%. Meanwhile, services and agri-sectors recorded a growth of 3.4 and 1.1 year-over-year. Looking ahead, our base case scenario assumes Sri Lanka's economy will grow by 4% for the year 2026, which is slightly above the latest projection from IMF and World Bank, which are around 3% and 3.5% respectively. Moving on to inflation, the external shock had a significant impact on inflation, pushing it to a three-year high. This was largely a supply-driven increase driven by the sharp rise in crude oil prices. As the fuel import bill increased, the local fuel prices also rose around 50%, and the immediate first-round effects becoming visible across the economy. Our inflation forecast for the year-end is now increased to 7.5% and expected average inflation to record 6% on a year-on-year base case scenario. Assuming the oil prices to normalize going forward in the near term, we expect inflation to come below 5% target, 5% range by the mid of 2027. Moving on to our currency outlook, the Sri Lankan rupee remained relatively stable from 2025 through February 2026. However, following this escalation, concern over potential supply chain disruption led importers to front-load imports, while higher global fuel prices increased our country's import bill as well. These factors, combined with speculative foreign currency demand, place significant pressure on the exchange rate, resulting in the rupee depreciating more than 10% by the mid of 2026. In response to this, CBSL shifted its position from being a net buyer of USD and becoming a net seller in the month of April and May after being a net buyer for continuously 22 months previous to that. CBSL also reduced the mandated conversion window for exporters to convert the residual foreign currency earnings from 90 days to 30 days. Following these measures, the rupee has stabilized in the range of 330 to 335 against the USD. Looking ahead, we expect the currency to remain under pressure but broadly stabilized level, with our base case assuming the exchange rate of around 340 rupees per USD by the year-end 2026. That said, moving on to central bank policy rates and market interest rates, the CBSL raised the overnight policy rate by 100 basis points to 8.75 in May 2026. This shift towards tightening the tightening the monetary cycle. The move was aimed at containing the inflationary pressures and supporting the external stability. The overnight policy rate was kept unchanged at July monetary policy meeting, allowing the impact of the May rate hike to transmit through the economy while maintaining a tightening bias. The market interest rates appear to have passed their cyclical lows, with the Treasury bill yields expected to remain elevated in the near term amid tighter liquidity conditions. Lending rates also repriced following the policy rate increase, with average weighted prime lending rate rising to 10.62 levels, which is an increase of 1.4 percentage on a year-to-date basis. When we move on to uh, credit to private sector, the private sector credit expanded 25% in 2025, supported by recovery in the economic activity. However, the strong pace of credit expansion also contributed to higher consumption, including import-related demand. Despite the increase in uncertainty during 2026, the private credit continued to grow, recording an 8% year-to-date growth as of first 5 months of the year 2026. During this period, the monthly credit expansion averaged around 165 billion compared to 175 billion per month for the year 2025. This indicates the credit momentum has remained relatively stronger so far. However, with the recent increase in the interest rates and tighter monetary conditions, we expect this pace to moderate over the remainder of 2026. The credit to GDP recovered around 32% in 1Q 2026, returning to its pre-crisis range of 30 to 35%. Going forward, with the moderation on the credit growth, we expect the credit to GDP ratio also to stabilize around 30% in the near to medium term level. Moving on to our fiscal performance, revenue performance for 2025 remained relatively very strong, with revenue to GDP ratio surpassing 15%, supported by stronger income tax collections and higher indirect tax revenue and additional contributions from vehicle import duties. During the first 5 months of 2026, the total government revenue reached around 2.5 trillion, ahead of our expectations. If this momentum is sustained, the government remains broadly on track to achieve its annual target revenues. The Inland Revenue Department remained the largest contributor to the government revenue, accounting for 47%, followed closely by Sri Lankan Customs at 46%. On the expenditure side of things, the total government expenditure for 2026 is budgeted around 7.6 trillion, which includes 1.4 trillion of public investments. However, the public investment execution has remained relatively subdued, with capital expenditure utilization amounting only to 230 billion for the first 5 months of this year. During the first 5 months of 2026, the government recorded a budget surplus of rupees 197 billion compared to a deficit of 237 billion during the same period. Meanwhile, the primary surplus increased to 1.1 trillion, up 52% year-on-year. Overall, these trends reflect sustained progress in revenue mobilization and improved fiscal balances, while the pace of expenditure execution, particularly capital spending, remains a key risk to an area to monitor. Moving on to our external sector and trade outlook, exports grew by 6% year-over-year and imports increased by 27% year-over-year, with trade deficit widening to 5.5 billion in the first half of 2026. Textile exports are expected to remain the largest contributor to Sri Lanka's export earnings, accounting about 35% of the total exports. However, this sector has faced headwinds recently due to tariff-related developments and uncertainty surrounding the global trade. As a result, textile exports declined by 5.9% year-over-year in the first half of 2026. Currently, Sri Lanka faces a 10% reciprocal tariff on the exports to US, with an effective total tariff around 26%. While this tariff situation remains uncertain, we expect the apparel and textile exports to remain volatile in the near term given the inflationary pressures in the key source markets and the evolving global trade environment. Tea exports also came under pressure, declining 5.9% year-over-year during the first half, as the Middle East is the largest tea export markets for the country, has faced weaker demand conditions. Moving on to import side of things, imports have increased 29% year-over-year. This is primarily the recovery in the vehicle imports and higher energy costs. Personal vehicle imports increased by 250% year-over-year, accounting for 8% of the total imports. Meanwhile, the refined petroleum imports increased 62% to 2.5 billion, representing around 20% of our total imports for the first 6 months of the year. To provide some context, the refined petroleum accounted for 20% this first half. However, compared with the last year, for the full year, it compared around 13%, and for the 2024, it was composed around 16% of the total import level. Against this backdrop, we expect exports to remain broadly flat in the year 2026, followed by a modest recovery around 2% for the year 2027. However, imports are expected to increase by 15% year-over-year in 2026 before remaining broadly stable in 2027. Hence, we expect the trade deficit to widen around 11.1 billion for the 2026 and 10.7 billion for 2027. Part of this deficit is expected to bridge through the worker remittances and tourism, where worker remittances continue to remain a key support in Sri Lanka's external position. The work remittances reached around 4.6 billion for the first 6 months of 2026, and we expect the inflows to reach around 8.9 billion for the entire year. This is primarily supported by stable overseas employment movement and the continued inflows from the migrant workers. Tourism remains another important source of foreign exchange earnings. We expect tourist arrivals to reach around 2.3 million in 2026, which to further improve approximately to 2.8 million arrivals in 2027. And tourism earnings are expected to increase around 2.9 billion for 2026 and 3.3 billion for 2027. During the first 6 months, the tourist arrivals reached around 1.14 million, while India remained the largest source market, accounting for 26% of the arrivals, followed by UK at 9% and Russia and China with 7% respectively. In terms of gross official reserves, Sri Lanka's reserves stood at around 6.5 billion as of the first half of 2026. While the central bank was a net seller in foreign exchange for the month of April and May to support the market stability, it remained as a net purchaser with 570 million during the first half of 2026. This reserve accumulation over the broader period of the time. While the IMF program envisaged a target of 8.6 billion for the 2026, achieving this level may remain challenging given the prevailing external headwinds and elevated uncertainty around the global commodity prices and capital flows. Next. To summarize our macro outlook, we have developed 3 scenarios based on key variables that could influence Sri Lanka's economic trajectory for the year 2026. Given the heightened uncertainty surrounding the Middle East conflict, our outlook is built around 3 possible scenarios: a base case, a bear case, and a bull case, which each scenario primarily driven by 3 assumptions for the global oil prices. Under our base case scenario, we assume the Brent crude oil to average between $75 and $85 per barrel. This translates into a GDP growth of 4% and inflation peaking around 7.5% by the year end. And we also expect rupee to settle between 335 and 340 against dollar, and we also expect corporate earnings to grow between 3 to 5% for the year 2026. Under our bear case, if the conflict persists and the Brent move above $90 per barrel, we would expect GDP growth to slow down between 2.5 and 3.5% and inflation to move into double digits And in this scenario, the rupee could weaken beyond 350 and corporate earnings would likely to turn negative. On the other hand, under our bull case scenario, the de-escalation in the conflict with Brent oil easing between 65 to $75 could support stronger GDP growth up to 5%. This would bring inflation below 5%, and in the environment we would expect rupee to strengthen below 330 and corporate earnings to grow in the high single digits. We currently assign a high probability to our base case scenario, though as always the path forward remains closely tied to how the geopolitical situation evolves. With that macro section, we are moving on to Colombo Stock Exchange performance. The Colombo Stock Exchange delivered a strong year in the 2025, and all-share price index gaining by 42% for the year 2025. But ASPI started on a positive note on 2026. However, it fell with the war by 11% to 21,100 levels after the war tensions, oil prices, currency depreciation concerns, and more cautious investor sentiment weighed on the equities. As the chart on the right illustrates, the corporate earnings have always remained primary driver for the ASPA performance over the past decade. The relationship held largely consistent with the projections of our earnings corporate to remain around 3 to 5% in our base case scenario. We expect in the near to medium term the outlook is a bit moderate. However, it will gradually improve as the situation in the Middle East improves over the medium to longer term. That's all about macro and CSE highlights. I will now hand over to Sachin to continue with the equity strategy and sector outlook.
Yeah, thank you, Guru Prasad. So, just before we go into the equity strategy again, like Guru said, our base case scenario for corporate earnings growth is still beyond the base case. So, given that we have identified a few key sectors that we are more kind of bullish or are more resilient on. So, if we kind of start off with the first sector, first will be the banking sector. So if I were to start off with the positives, the biggest near-term support that the banking sector currently has is on the margins. After the policy rate hikes, the lending rates have moved up much faster than the deposit rates. So that should inherently continue to see some support for the NIMs of the banks over the next few quarters in the short term. We are also seeing the funding conditions improve as well. So the banks have started attracting more deposits, which then means that they are becoming less and less resilient, less and less reliant on the selling of government securities to fund their loan growth. Coupled with the strong capital buffers that the banks have built up over the past few decades with debenture and rights issues, this leaves the sector well placed for any future balance sheet growth. As well, on the other hand, if you look at the operating environment, that is where the biggest challenge comes from, with the 100 basis points policy increase that is likely to slow credit demand. We expect the loan growth overall to moderate throughout the rest of the year. And at the same time, the deposit rates are gradually catching up as well. So the current benefit that the NIMs have is unlikely to last indefinitely. So the margin expansion that we would see should start to normalize as well. The asset quality is another area that we'll be watching as well, with reported NPLs having continued to improve over the last few quarters. The rapid loan growth over the past year is still relatively new, which then means that the loans need some time to season. So together with the lingering impact of the cyclone Ditra of last year on some borrowers, we think there is some potential for the increase in NPLs as well as credit costs over the short and medium term. Finally, if you look at the single borrower limit, that continues to limit the bank's ability to book very large corporate loans. It's not a major headwind for the sector overall, but it does influence how banks allocate capital and encourages a more diversified lending mix. So all in all, in terms of our banking sector, our recommendations are on commercial, Nations Trust Bank, Sampath Bank, and HMB. So if I were to give some quick highlights on the four banks, commercial bank, with its sector-leading CASA, cost-income ratio, as well as low NPLs, combined with a strong loan growth potential as well, delivering industry-leading ROEs. We believe commercial is ranked among the best in terms of the banks. If you look at our other rankings, will be Sampat, which benefits strongly from its credit cards and remittances, as well as the leasing business as well. Whereas HMB has seen good and strong recoveries coming through in terms of their NPS, as well as having industry-leading capital buffers as well. Nations Trust Bank, again with its HSBC acquisition, is likely to have a big benefit in terms of both their funds that is available to be deployed, as well as a new customer base for the future as well. So that kind of gives a good summary of why we expect the banking sector to be the most resilient, as well as optimistic in terms of the sectors. Another sector where we expect a lot of resilience is the telecom sector. This is where another sector where we remain positive on the earnings outlook, mainly because the growth story is increasingly being driven by higher data usage rather than subscriber additions. So data consumption has continued to grow strongly this year, as you can see on the bottom right. This is mainly supported by better network speeds following the 5G rollout, higher social media engagement, as well as improving consumer spending. And as a result, the operators are seeing higher usage, even though the number of subscribers have remained relatively stable. This has also translated to stronger profitability and earnings. The combination of rising data consumption, tariff revisions, as well as the rollout of new 5G services have supported the earnings in a positive way. And looking ahead, the government's digitalization efforts and agenda and the continued growth in media consumption should also provide a structural tailwind for the sector by driving higher demand for reliable and high-speed connectivity across both consumers as well as businesses. If you look at the challenges within the sector, the main one is the competition. So currently, while not in play, the implementation of number portability could make it much easier for customers to switch between providers, and that could in turn increase competitive pressure across the entire industry, putting pressure on ARPU levels as well as churn levels. And then if you look at the cost-related risk, any depreciation of the Sri Lankan rupee would inherently increase the cost of network investments, and also increase the cost of imported telecom equipment, given that the sector's exposure to foreign currency denominated capex. In addition, another risk that the telco sector is facing would be the subscriber growth that is largely stabilizing, which means that the operators are have an increasing need to rely on the higher data usage as well as value-added services to sustain revenue growth going forward. So if we look at within the telco sector, currently the two listed stocks that we have are SLTL and Dialog. So SLTL, it is the market leader when it comes to fixed and corporate IT solutions. It also benefits from international expansion through the Syntax Singapore, where they can provide services using its strong submarine cable infrastructure. And if you look at Dialog, it is the market leader when it comes to mobile, and it is the only operator that has taken over the high capacity gigabit speed spectrum along with the commercial 5G spectrum as well. So kind of moving on from, let's say, the telco sector to our conglomerates. So here, again, this is a sector where we kind of see the benefits of diversification coming through, especially in times of these macroeconomic headwinds. So if you look at our kind of recommendations, if you will be Melstar, KMAS, John Keells, and Aiken Spence, where Mels, the beverage segment, will be kind of the main core earnings driver, while Ahun is expected to actually remain resilient despite the lower tourism arrival numbers. If you move on to HEMAS, that is kind of expected to benefit from its inorganic expansion towards HEMAS. However, their healthcare segment remains under kind of pressure due to the NMRA pricing policies. Going on to John Keells Holdings. So John Keells Holdings are set to benefit from its transportation business, which is their port businesses, as well as the retail performance from its CCS and BYD businesses, where the leisure segment through City of Dreams as well as KHL and HPL is kind of expected to remain under pressure for this year as well. And of course, JK stands to benefit from the financial services segment, which includes Nations Trust Bank as well. And if we look at spend, Aegon spends, despite the slowdown in tourism segment, their earnings from its strategic investments as well as services segments are expected to kind of provide an uplift to their profitability. So that is the three sectors that we are resilient and optimistic on. So if we now move on to a few sectors that we still believe has some potential but are kind of hindered with the macroeconomic conditions. So if we move on to first the construction sector, here again our view is a bit more cautious compared to the previous sectors that we talked about. So while the activity remains healthy, we think that the sector is likely to face increasing headwinds over the remainder of the year. So on the positive side within the sector, the construction activity continues to be supported by post-recovery construction, along with the ongoing public infrastructure as well as condominium developments. The construction PMI has remained in an expansionary territory for most of the year. Both new orders and employment have continued to improve, suggesting that underlying demand still remains resilient. That said, much of the current momentum seems to be coming from projects that are already underway rather than a strong pipeline of new project commencements. So as a result, we think the pace of the growth is likely to moderate as the year progresses. So the macro backdrop as well has become much more challenging, as we would already know from the Middle East conflict. So because of this, commodity prices have increased, freight cost has increased, as well as the rupee has depreciated. All of this has pushed up the construction input costs. So while certain material supplies have been able to pass on some of these costs through price increases, sustained cost inflation is more or less likely to weigh in on the project affordability, which could then inherently delay investment decisions. Also, in the construction sector, we expect the private sector construction to soften during the second half of the year. This is particularly across hotels, logistics, and urban housing, mainly due to the higher financing and construction costs. Also, while critical government infrastructure projects continue to provide some support, any fiscal pressures could then affect the pace of public capital expenditure, as we've seen in previous years, creating execution risk for the broader sector as well. So overall, while the sector remains in an expansionary phase, we believe the growth is becoming increasingly dependent on existing projects, with new investments likely to face more difficult operating environment. So having said that, if I go on to our recommendations, so while again Tokyo Jet and ACL, like I mentioned earlier, move towards the retail side, are able to move towards the construction material side rather, will kind of look into pass on prices to their customers. They will also have to be mindful of competition and demand conditions as well. However, on AEL Access Engineering, we are a bit more bullish and optimistic, mainly given their diversification as well as their exposure to more government sector projects, which seem to be going on as well. So even in recent times, the government has been awarding contracts for certain construction projects, such as the Central Expressway and the Bandar Naik International Airport as well. So, excuse me. So given those conditions, we kind of place Access on a more optimistic light compared to the rest of the construction sector counters. And another sector, again, the consumer sector, is a very kind of sensitive sector to the macroeconomic and economic cycles. So the main kind of challenge we are seeing within the consumer sector is the elevated electricity tariffs, high transportation costs, as well as high inflation, which is putting pressure on consumers and their disposable income. At the same time, we've seen that the global oil prices have been rising, and again, the earlier mentioned rupee depreciation has increased the cost of imported inputs as well. So although companies can pass through cost via price increases, softer demand is likely to limit the pricing power, creating margin pressure. This is especially true in terms of your consumer sector companies. And weather conditions also plays a key role here, especially given the El Nino weather impact that is going on currently. So this increases the chances of disruptions to the local agricultural production. And at the same time, weaker global crop use could also increase the cost of imported agriculture inputs that we rely on heavily as well within the country. So with the so with the reduction in discretionary spending, with the reduction in discretionary spending levels, we also expect certain demand for things like vehicles as well as other consumer durables to moderate due to high interest rates and tighter financing conditions. And with the high interest rates, personal loans and consumer financing may also be slowing down as well. Having said that, a positive would be the demand for essential goods and FMCG products that should remain relatively resilient given their non-discretionary nature. We also expect modern retail to continue expanding, although the focus is likely to be on improving operational efficiency rather than aggressive store expansion. And overall, within the sector, we expect consumer demand to remain subdued through the rest of the year, with a clear divergence between essential and discretionary categories. So having said that, if we go on to our kind of recommendations within the sector, what we look at are distilleries, CCS and CTC, where CTC is a counter that has been very investor friendly in terms of their dividend payout and dividend yields, and CCS with its supermarket and supermarket business continues to expand and record strong footfall growth numbers as well. So given that's a quick highlight of our recommendation within the consumer sector, finally, another sector that is very key for Sri Lanka as a whole is the tourism sector. I think, as we mentioned earlier within the macro as well, that the earnings from tourism plays a key role in terms of our reserves and then again, consequently, the exchange rate as well. So Sri Lanka's tourism during the first half of 26 witnessed softer performance, with tourism arrivals declining by 1.8%. However, the decline in tourism receipts, that is revenue from tourism, was more pronounced, falling 11.8% year-on-year, primarily due to the reduction of average spend per tourist of about 10% on a year-on-year basis. This shift actually reflects a lower spending visitor segment and highlights challenges in Sri Lanka in translating the arrival growth numbers into higher tourism earnings, like we have been seeing over the past few quarters as well. If we look at the positives for the tourism sector, the tourism growth is supported by rising Indian tourist arrivals, with the Indian segment recording higher average spending per visitor as well. Alongside this, the improved visa accessibility through visa-free agreements as well as digital processing, ongoing infrastructure developments, including port city and BI expansion, are also expected to strengthen the sector's long-term competitiveness as well. So the key challenges within the tourism segment currently is the uncertainty in terms of the outlook, mainly with the disruptions to air connectivity, airfares, and also the constraints at key transit hub, weighing in on tourist arrivals, particularly from long-haul markets. So in addition, rising electricity tariffs and oil prices could also increase operating costs and place pressure on margins on the tourism counters, while declining arrivals from high-spending European markets may weigh in on the overall tourism earnings. So going forward, I think as we mentioned earlier, we expect a gradual recovery in tourist arrivals, with our forecast for 26 standing at 2.3 million arrivals and 2.8 million arrivals for 2027. So with that, that kind of brings us to the end of our overall sector discussion. And we can kind of quickly glance over our overall recommendations as well. So this kind of incorporates everything I mentioned earlier into one, well, at least half of it here. So a few companies that weren't kind of highlighted or discussed earlier in the section would be AIC, that is SoftLogic Insurance, as well as Pygmy as well. So Pygmy is another counter that again has a lot of potential in terms of their growth story. And then again, insurance is another sector in Sri Lanka as a whole, which remains kind of underpenetrated with a long-term potential as well. And yeah, so this is the kind of second part of the recommendation slide. Again, I think most of it here has been covered during our earlier sections. And then with that kind of brings us to the end of our presentation slide. Presentation slide. So I think we can open up the panel, open up the meeting for a Q&A session. So if you please do have any questions, type your questions in the chat box, and we will get back to you on the questions. So far, we have received one question that is on the BIA phase 2, whether when will the BIA phase 2 happen, and does AEL have a view on this? So unfortunately, I am not in a position where I can comment on AEL's views on this right now. However, what we have heard on the BIA phase 2 is that the contract is kind of dependent on the Japanese parties involved, where that we are just kind of waiting for the green light from their end to go ahead with the project. So that's just kind of what I can provide in terms of the BIA phase 2. However, what we've seen recently is that in the meantime, the government of Sri Lanka has been kind of trying to improve other aspects of the airport. So the terminal, the phase 1 terminal is getting some capacity expansion and improvements as well. So in the meantime, there are construction activities going on in terms of that aspect. Once again, I would like to remind everyone that if you have a question, you can please use the chat box or use the raise the hand function, and you can unmute yourself and ask question as well. So we got another question. So that's on what would be the trigger for the banks to re-rate. I think I can maybe hand it over to Buddha to kind of take you over that. The triggers for the banks to re-rate.
So in terms of banks, what we have witnessed in the first quarter results is like most banks we cover, like Sampath, HNB, NTP, and Commercial, have achieved half of their full year loan growth target. So even with the interest rates being increased when the most of the banks enter in floating rate agreements, we can expect NIM to sustain at this level. However, re-rating on banks may weigh on how the entire equity market being viewed among the investors and the people. So it's most likely there is a defensive counter, and it will be hold in these levels, and it will outperform other sectors when compared to other sectors compared to other sectors, banking sectors will be remain resilient. So that's how we want the banking sector. And we also have seen ROEs have been constantly over 15 to 20% within the range of banks we cover, and their stage 3 ratios also has come down. Most of the banks have come down around 1 to percent levels. So those are positive factors to elevate the banks in a better way. Hope I answered your questions.
If there are no further questions, I think we can wind up our meeting. Yeah. Sorry. Yeah, we received another question. So sorry. Go ahead.
So there's a question from on the based on our channel checks. Are you seeing a slowdown in consumer demand volume post June? Usually, with the second order effects like from the war, we can see the next half to be a bit sluggish, even though there are a few other essential elements, as we earlier mentioned in the presentation, will continue to have a strong have a demand. In terms of discretionary and all, we might see a slowdown in growth projections. Uh, yeah, that's our view.
We also received another question. So this is more on the liquor side of things. So the question is, how are hard liquor sales trending?
Yeah, actually on hard liquor sales volumes, what we have seen so far is for FY26, we saw 15% of volume growth for hard liquor. But going forward, what we expect is a kind of slowdown in sales volumes because majorly we saw that extra special rack increased by 20 rupees. And going forward, we kind of expecting an excise duty revision in January because of now excise duties are indexed to inflation, and inflation is at now surpassing 7%. So we probably see the probability of rise in excise duties is high now. So going forward, next 12 months, we kind of expect a slowdown in this strong volume growth we saw so far. Yeah.
We have also another question on the CSE side of things. So the question is, why are we seeing low foreign participation in the CSE over the last 3 months, and that too on heavy foreign selling? So maybe Kuga maybe you can take over.
Last 3 months, in the sense, in the month of May, we had a policy rate hike, which in even turned to a 150 basis point hike in our bond markets. So there's basically a shift in our interest from choosing the asset classes, and also when we look at not only on Sri Lanka, in the regional equity market as a whole class, we are seeing there's drawing interest from risky asset people are investments are moving from risky assets to more of a risk-free assets. So that one reason we have seen across among the region as a whole. So that one reason we are looking for why the participation in low participation in foreign over the last 3 months, and also to see our bond market being relatively attractive compared to the CSE in the last 3 months. So that's one of the reason we highlight here on the market movement and activity.
We have also a couple of questions on Tokyo. So the first one is, what is the current market volumes for cement, and has Tokyo been able to defend the market share? And the second one is, Tokyo announced a 2.5 rupee dividend for FY26. Why do you expect this to decline for FY27?
So in terms of market share, Tokyo was able to maintain a market share between 30 and 32%, despite the market like cement volumes have been like there's a heavy competition among the cement manufacturers and the players in the market. Because what we have seen here is like there's a heavy competition from Langwa cements and all. Most of the players are selling below MRP. This is like pre-war situation. So, so Tokyo also have to cut down its prices below MRP to retain its market share. What's the next question?
The second one is on the dividends. So, as Tokyo announced a 2.5 rupee dividend for FY26. Why do you expect this to decline for FY27?
So in terms of so actually in terms of our we are sharing our recommendations. So in terms of dividends, we are expecting a 2.8 dividend for the year 2027, and 2026 it has been 2.5 rupees. So it's a slight increase of 30 cents in terms of dividends. So in terms of 25 to 26, it's broadly flat because of the more of the projects they are coming in. So we expect that expecting a lower dividend yield for 2026, and followed by we are seeing an increase in 2027. So hope I answered your question.
Go ahead. Yeah, I think that kind of brings us to end to the webinar. Once again, I would like to thank everyone for your time for joining us today, and hopefully we were able to kind of give you some important information, that helpful information. So if you have any further questions, please do feel free to reach out to any of us in our team. We will be more than happy to get back to you. And in the meantime, hoping you all have a pleasant rest of the day. So yeah, thank you once again.